The IRS just released something that could save you over $6,000 next year. On October 9, 2025, they published Revenue Procedure 2025-32 with all the official 2026 tax numbers. And buried in this document are 7 changes that 90% of taxpayers will completely miss. But if you know what to look for, these changes could put thousands of extra dollars in your pocket. Let me show you exactly how. Look, I know tax season feels overwhelming. You are probably thinking, here we go again, more complicated rules, more forms, more confusion, but here is what makes 2026 different. These changes actually simplify things and put money back in your pocket if you know how to use them. The IRS adjusted almost everything for inflation. Tax brackets expanded, standard deductions increased, and some numbers jumped by amounts nobody expected. Change number 1. Tax brackets expanded by roughly 2.8% across all 7 rates. Now let me explain why this matters using the bucket system. Think of tax brackets like buckets stacked on top of each other. The first bucket is your 10% rate, the second bucket is 12%, and so on. For 2026, all those buckets got bigger. That means you can fit more income at lower tax rates. Here is a real example. A married couple filing jointly. The 22% bracket now goes up to $211,400. That is $5,650 higher than 2025. That first $5,650 that would have been taxed at 24%, now it is only taxed at 22%. That saves you $113 right there. And that is just one bracket. Change number 2. The standard deduction increased significantly for 2026. Single filers get $16,100. That is $1,100 more than 2025. Married couples filing jointly get $32,200. That is $2,200 more. Now hold on, let me show you why this matters. The standard deduction is the amount of income you can earn completely tax-free, zero federal tax. So if you are a married couple and your combined income is under $32,200 after adjustments, you pay nothing in federal income tax. And here is the kicker. If both of you are 65 or older, you each get an additional $1,650. That is $3,300 more. Your total standard deduction could be $35,500. Up to 22% tax bracket, that additional $2,200 increase saves married couples $484 every single year. Change number 3. This is huge for anyone with investments. Long-term capital gains tax brackets expanded, and the 0% rate got way more generous. Listen to this. For a married couple filing jointly, you can have up to $98,900 in long-term capital gains and pay absolutely zero federal tax on it. Zero. Let me give you a real-world example. John and Mary are retired. They have $70,000 in income from pensions and Social Security. After their standard deduction of $32,200, their taxable income is about $37,800. They sell some stocks they have held for over a year and realize $61,100 in gains. How much do they pay in capital gains tax? $0. Because their taxable income of $37,800 plus the $61,100 in gains equals $98,900. They stay right at that 0% threshold. That is a capital gains tax savings of $9,165 compared to if those gains were taxed at 15%. Change number 4. Short-term capital gains are still taxed as ordinary income. This is where people get crushed. If you buy and sell an asset in less than 12 months, it is short-term, and short-term gains are taxed at your regular income tax rates, 10% to 37%. Here is what this means. Let us say you are in the 32% tax bracket. You make a $50,000 gain on a stock you held for only 11 months. You just handed the IRS $16,000. But if you wait just one more month to sell, it becomes long-term. It is taxed at 0%, 15%, or 20% depending on your income. For most people, that is a 15% rate. On $50,000, that is $7,500 in tax. You save $8,500 by waiting 30 days. This is why timing matters. Do not sell early unless you absolutely have to. Change number 5. The net investment income tax threshold did not change, and this is a problem for high-income earners. The NIT is a 3.8% surtax on investment income. It kicks in when your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples. These thresholds have not budged since 2013, not $1. Meanwhile, everything else went up, wages went up, inflation happened, but this threshold, frozen. What this means is more and more people are getting hit with this extra 3.8% tax every year. So let us say you are a married couple. You make $300,000 in wages. You have $50,000 in investment income from dividends and interest. Your income is $50,000 over the NIT threshold. That entire $50,000 gets hit with an extra 3.8% tax. That is $1,900 on top of your regular capital gains or ordinary income tax. If you are close to these thresholds, you need strategies to keep your income below them. Things like maxing out 401k contributions, using health savings accounts, timing when you recognize income. Every dollar you can keep under that threshold saves you 3.8 cents in extra tax. Change number 6. This one shocked me. The estate tax exclusion jumped to $15 million for 2026. Let me say that again, $15 million. This is not just an inflation adjustment. Congress passed the One Big Beautiful Bill Act in July 2025, and they legislatively increased this amount. For a married couple with portability, that is $30 million in combined estate tax exclusion. Why does this matter? Because if you have significant wealth, this creates massive planning opportunities. Previously, the exclusion was around $14 million. This extra $1 million per person means you can gift more during your lifetime, transfer more wealth tax-free, and protect more assets from the 40% estate tax. But here is the catch. This amount could change with future legislation. If you have a net worth over $7 million, you need to talk to an estate planning attorney now, not next year, now. You can do lifetime gifting strategies, set up trusts, transfer assets while these higher limits are in effect. Every year you wait is an opportunity lost. Change number 7. Retirement contribution limits expanded again. For 2026, you can contribute up to $24,500 to your 401k if you are under 50. If you are 50 or older, you get an additional $7,500 in catch-up contributions. That is $32,000 total. Why should you care? Because every dollar you put in reduces your taxable income. Let us say you are in the 24% tax bracket. You max out your 401k at $24,500. That saves you $5,880 in federal tax for that year alone. IRA limits went up too. $6,500 for regular contributions, $7,500 if you are 50 plus. And health savings accounts. If you have a high deductible health plan, you can contribute $4,300 for self-only coverage or $8,550 for family coverage. These are dollar-for-dollar reductions in your taxable income. The more you can contribute, the less tax you pay, period. Okay, let me quickly recap the 7 biggest changes for 2026. Number 1, tax brackets expanded about 2.8%. You can fit more income at lower rates. Number 2, standard deduction jumped to $32,200 for married couples. That is $2,200 more of tax-free income. Number 3, capital gains 0% rate goes up to $98,900 for married couples. Huge opportunity for retirees and investors. Number 4, short-term capital gains still taxed as ordinary income. Hold assets at least 12 months. Number 5, NIT threshold frozen at $250,000 for married couples. More people getting hit with the 3.8% surtax. Number 6, estate tax exclusion jumped to $15 million. Massive for high net worth families. And number 7, retirement contribution limits increased. Max them out to save on taxes. If you implement even 3 of these strategies, you could save thousands of dollars in 2026. Now here is exactly what you need to do right now. First, if this video is going to save you money, smash that subscribe button and turn on notifications. I release tax saving strategies every single week that are based on official IRS documents. You do not want to miss them. The IRS releases new guidance constantly, and I break it down so you actually understand it and can use it. Second, this is important, empathetic. Share this video with one person who needs to know about these 2026 changes. If you have a friend or family member who invests, who owns a home in a high-tax state, who is planning retirement, or who has significant wealth, send them this video right now. You could literally save them thousands of dollars just by sharing. Third, comment below which of these 7 changes will save you the most money. Are you focused on maxing out that capital gains 0% bracket? Are you a high net worth individual who needs to update your estate plan? Or are you going to max out your retirement contributions? I read every single comment and I love hearing how you are winning with your taxes. Remember, these are not just numbers on a page, these are real opportunities to keep more of your hard-earned money. The 2026 tax year is your chance to implement these strategies and see real results in your bank account. But you need to start planning now. We are already in late 2025. The window to prepare for 2026 is right now. Every month you delay is money you could be saving. Thank you so much for watching. I will see you in the next video where I break down more advanced strategies for maximizing these 2026 changes.